Welcome to The Explainer. Today, we're going to crack the code on a topic that really powers the entire global economy, corporate finance. So, have you ever wondered how a giant company, a huge tech firm, decides to build a billion-dollar data center or maybe buy out a competitor? I mean, it seems impossibly complex, right? But it actually all boils down to a really clear framework for answering just two fundamental questions. But before we even get to those two questions, we got to establish the destination. What's the North Star here? What's the one single goal that guides every single financial decision a corporation makes? Okay, so at its heart, corporate finance is really all about managing a company's balance sheet. Just think of it like this. On one side, you've got the investment decision. That's what valuable long-term stuff should we buy? And on the other side, you have the financing decision. That's, okay, how are we going to pay for all that stuff? And the reason for all of this? The ultimate objective, right, the goal that trumps everything else, is to maximize shareholder value. I mean, every choice, from the smallest little operational tweak to the biggest merger you can imagine, it's all measured against this one single benchmark. Does this make the owners of the company, the shareholders, better off? That's it. All right, so let's dive into this. We'll start with that first big question that every single company has to answer. What should we actually invest in? So imagine you're the CFO of a growing tech company. You've got three huge proposals sitting on your desk. One is to build a state-of-the-art AI data center. Another is to launch a super flashy new app. And the third is to just buy out a smaller rival. Now, they all sound pretty good, right? But you can't fund everything. So how do you choose? You need a consistent, reliable rule to figure out which project actually creates the most value. And that's where the gold standard for making that choice comes in. It's a really powerful tool called net present value, or as you'll hear it called, NPV. Honestly, this is the bedrock of modern corporate finance. So why is NPV the gold standard? Well, it's because it's just incredibly rigorous. For one, it focuses on actual hard cash, not accounting profits, which, can be a little misleading sometimes. Second, it considers all the cash flows over the entire life of the project. And third, and this is a really crucial part, it properly discounts those future cash flows. Now, that's just a fancy way of saying it recognizes a dollar today is worth more than a dollar tomorrow because of risk and what you could have earned with it. So the rule is super simple. If that data center project has a positive NPV, it creates value. You do it. End of story. Okay, so you've done the work. You found a project with a fantastic positive NPV. That new AI data center? It's a go. Awesome. Now, how do you pay for it? Getting the money to make it happen. Well, that brings us right to the second key question of corporate finance. And this is what we call the capital structure question. It's really all about finding the perfect recipe for funding the company. We're talking about the specific mix of debt and equity it uses to pay for everything, its operations, its growth, and yeah, that brand new data center. So, a company basically has two main levers it can pull here: debt and equity. Think of debt as just a loan, plain and simple. You borrow money, you have to pay it back with interest. Equity, on the other hand, that's selling off little pieces of ownership in the company to investors. And as you can imagine, each one comes with a totally different set of rules, obligations, and benefits. So, how does a company decide on that mix? It's definitely not just throwing a dart at a board. No way. It's a strategic balancing act. It's a crucial trade-off that has huge, huge implications for the company's value and its overall risk. All right, the biggest advantage of using debt is this really powerful benefit called the tax shield. Here's how it works. If our tech company borrows money for that data center, the interest it pays on the loan is tax deductible. So the government is basically giving it a discount. And that makes debt a cheaper way to raise money than equity. It's a pretty big deal. But, of course, there's a catch. There's always a catch, right? The more debt a company piles on, the higher its fixed interest payments are. So if the market suddenly goes south and cash flow dries up, the company could be pushed towards bankruptcy. And those costs of financial distress, we're talking legal fees, customers losing faith, suppliers getting nervous, they can absolutely destroy a company's value. And this brings us to the central conflict, which is summed up perfectly in what's called the static trade-off theory. The idea is that companies are always searching for that optimal capital structure. They're trying to add just enough debt to get that valuable tax shield, but only up to the point where the growing risk of bankruptcy starts to outweigh the benefit. It is all about finding that perfect sweet spot. Okay, so let's bring these two huge pillars of corporate finance together now. So, at the end of the day, creating value is really just a continuous cycle of getting these two critical decisions right over and over again. First, you make smart investment decisions. That means only picking projects with a positive NPV, like our data center. And second, you make smart financing decisions, funding those great projects with the perfect mix of debt and equity. Answering these two questions well, again and again, is exactly how companies grow, how they innovate, and ultimately, how they build an enterprise where the whole thing is way more valuable than just the sum of its parts. That is how you truly maximize shareholder value. Now, all of this sounds perfectly logical, right? But this entire framework, it rests on one massive assumption, that the people running the company have the exact same goals as the people who own it. As the great economist Adam Smith pointed out centuries ago, when you're managing other people's money, well, your priorities might just be a little bit different. And that leads us to our final and maybe most provocative question. What happens when the managers, the people running the company day to day, have different motivations than the shareholders, the people who actually own it? That conflict of interest, that's known as an agency cost. And let me tell you, it is one of the biggest challenges in all of modern finance. But exploring that rabbit hole, that's a topic for a whole other explainer.